Good morning, everyone. For those of you I've not met before, my name is Lexi Shaw. I'm a partner at AC Mole, and it is my pleasure, on behalf of Clarke Willmott and AC Mole, to welcome you here to our budget breakfast this morning. I'd like to start by saying how nice it is to be able to be back here at the racecourse, and that wasn't an intentional joke, and to see you all in person this morning. It certainly feels like a very long time since we were able to be here in person, and obviously a lot has happened since. So it's been lovely just to be able to catch up with some of you here this morning. And in our new hybrid world, we are live streaming our event this morning. In fact, I need to stand in the right place. So I'd like to extend a welcome to the 70 or so people who are joining us online this morning. You have missed a great breakfast, but hopefully you'll be able to join us in person again soon as well. So it's my pleasure this morning to have the role of introducing our speakers. And we're joined again by Amanda Gunter, tax partner from AC Mole, and Tom Chiffers, partner on the private client team at Clarke Willmott. And I, for one, are very interested to hear Amanda and Tom's take on Wednesday's announcement. There was certainly a lot of talk about spending, less information on perhaps where that money's coming from, but I'm hopeful that Amanda and Tom might be able to shed some light on that for us. So really, all that leaves me to do is to say, to hand over to Amanda and Tom. There will be the opportunity to ask questions at the end of the presentations. So if you do have any burning questions, do store those up, and I'll be hosting a Q&A session at the end. For those of you joining us online, there is also the opportunity to ask questions using the chat function. You do need to be logged in using your Google account, but again, do feel free to submit those, and we'll be taking those at the end as well. So really, that just leaves me to hand over to Amanda for the first of this morning's presentations.
Good morning, everybody. It is nice to see everyone here this morning, and thank you for those joining us on the live stream there. It's actually nice to be back at the racecourse for something other than vaccines and PCR tests, so thank you to the racecourse for having us back. Now, there's too many things in my hand here, but hopefully this is going to work. Here we go. Right, on Wednesday, I don't know if anyone else sat down and listened to the budget and thought, well, there wasn't an awful lot in there. But that seemed to be the case as we were going through. There was an awful lot of announcements on spending, as Lexi mentioned, but there didn't seem to be very much else in relation to tax matters. So I sat in the conference room with our tax team, avidly watching the budget, and we were all sat there waiting and waiting and waiting. Now it got to about 40 minutes, and normally at 40 minutes, that's where all of our ears prick up, because it tends to be the point that he does start making the tax announcements. But he didn't say hardly anything, and he didn't do anything in relation to tax raising matters. But he did announce an awful lot of spending. Now, a lot of it he'd mentioned before the budget as well, and I was left thinking, well, this doesn't really work for me. I'm an accountant and I like things to balance. So if I hear about spending, then I do like to hear about how we're actually going to raise those funds. So on Wednesday afternoon, I spent the afternoon writing our budget flyer, reading more about the budget and thinking about exactly how is he going to raise these funds for this additional spending. Now, as I was thinking it through, he never said it was going to be additional spending. It just seems to be that actually he was going to maybe reallocate spending. So some great announcements, positive comments, but was he really giving additional funding or just reallocating it? Now with any budget, the Chancellor always stands up and announces all the positives that you can think of. And they always put a positive spin on anything that may not actually be a positive. This was no exception, and so this year actually he did start with inflation, which may not be quite a positive, because inflation at the moment is a little bit higher than they would like. So inflation in September was at 3.1%, and the Office for Budget Responsibilities is predicting that next year's inflation rate is going to be 4%. Now this is being pushed by the fact that you may have found when you're looking at your shopping at the moment that our demand is actually outstripping our production, and that is on a global basis, which is helping to push up that inflation rate. The government's target for inflation is 2%. So actually at 4%, we are double what they were hoping to achieve. Now, during his speech, I did have to write this down so I could read it to you word for word. The Chancellor did say that where the government can ease these pressures, they will act. He then went on to note that he'd written to the Governor of the Bank of England to reaffirm their remit to achieve low and stable inflation. But that's as far as he went. He didn't explain anything else as to how they were going to achieve any of that. He simply left it as a statement. I think we are going to have to keep an eye on inflation because, as you can see from my very quick diagram, things are going to cost us more over the next year. Now, with the speech, once again, it was peppered with some positive comments. And the first one he was making was in relation to growth. So our growth for this year is predicted to be 6.5%. That's a good thing because it's higher than they were originally expecting. The Office for Budget Responsibilities is predicting that next year growth will hit 6%, which again is higher than they'd originally thought. Thereafter, they are doing a long-term forecast of 2.1%, 1.3% and 1.5%. Now, they're expecting that the UK economy will return to pre-COVID levels by next year, which is a good sign. The next positive that he ran through was in relation to unemployment. So they are expecting unemployment to peak next year at 5.2%, which is again lower than they were expecting, and the current unemployment rate is lower than they were expecting. Originally, the Office for Budget Responsibilities was stating that the unemployment rate by next year would hit 11.9%. So, all good news. Now, the Chancellor, I thought, was very clever when he was announcing borrowing, because again, he put a positive spin on borrowing. And he stated that our borrowing this year was going to be lower than expected at 7.9%, and it's going to fall dramatically next year to only 3.3% of our gross domestic product. But let's not forget what borrowing is. Borrowing is the amount we need over and above our income to cover our costs. So for this year, we need to borrow 7.9% of our gross domestic product in order to cover all of our costs. Which means next year, yes, that is going to go down to 3.3%, but we still need to borrow in order to cover all of our costs. Now, what the Chancellor didn't mention was our debt position. So our debt is the total amount that we actually owe. So an amalgamation of each of our year's borrowings. Now, does anyone want to take a guess at what our total debt is? 2.2 trillion. That is a very big figure, all right, in anyone's books. And it also means at that sort of level, if we see any small changes in interest rates, it does have a significant effect on our cost base for the year. It's a very big figure. So although the Chancellor was putting a positive spin on our borrowing, we are still borrowing. So how exactly are we going to repay any of that debt? Because in the budget, there were hardly any announcements in relation to tax-raising items. And this was the area that I was thinking about for most of Wednesday afternoon. It's what us as accountants do. We like to know how we are going to balance those books. And when I looked at the detail, it was showing that in the future we would aim to reduce our debt. Now, I looked at it and I thought, how on earth are we going to do it? And part of it comes back to the announcements he actually made earlier in this year. So in his March budget, he made a number of significant announcements in relation to taxation, including freezing a lot of allowances and thresholds. That was one of the ways that he is looking to raise taxes to hopefully in the future start to balance up our books. The other way is he's hoping that our growth and our unemployment will continue to fall in the future quite quickly, because that helps with our debt position. So let's have a look at some specifics. We're going to start with company taxation. So the corporation tax rate is still at 19%. It's been at that rate for a little while, so excellent news, that stayed the same. But let's not forget what he did in March. He announced that he's going to increase the corporation tax rate to 25% from the 1st of April 2023. Now that 25% rate is going to apply to profits over 250,000. Now, he also introduced a small company rate. So for small companies where their profits are less than 50,000, the tax rate will continue to be 19%. For businesses that have got profits between 50,000 and 250,000, the rate will be between 19% and 25%. So one of the announcements he did make in the budget was in relation to research and development. This is something that they love to tinker with on what seems to be a constant basis. There don't seem to be many budgets nowadays where they don't mention research and development and announce a small change of some sort. Now these changes were quite specific and what I would call not overriding changes. They're just very small changes. So from April 2023, so this isn't going to take effect for quite some time, they're going to allow to include modern research methods, which includes things like data and cloud costs, as part of the research and development tax relief claim. So they're simply adding something else that can go into the claim. Now, the one thing you mentioned here is it said they will be restricted to innovation undertaken in the UK. Now, I use the word restricted, the Chancellor used the word refocusing. Here, what they're trying to say is that for research and development, you will only get the tax relief where the research and development is undertaken here in the UK. So he's trying to stop relief going outside of the UK and the work in relation to research and development going outside of the UK. So one of what I think was the biggest announcements from an accountancy perspective was in relation to the annual investment allowance. So the Chancellor announced that the £1 million annual investment allowance will be extended until the 31st of March 2023. Now some of you may know that the annual investment allowance was due to drop to 200,000 from the beginning of next year. So he's simply extending the £1 million allowance for a further period. After the 31st of March 23, at the moment, it is due to drop back to 200,000. But let's not forget something else he announced in March. We also announced the super deduction. So back in March, he announced that from the 1st of April this year through to 31st of March 2023, there will be a super deduction in relation to capital expenditure. The super deduction is in addition to the annual investment allowance, so it's not either or, it is in addition. The super deduction will allow for 130% relief for qualifying expenditure. In very basic terms, qualifying expenditure is new plant and machinery. Now there are some exceptions to the super deduction, and one of the big ones that a lot of people already know is cars. Cars do not fall within this super deduction. The other thing that doesn't fall within the 130% relief is what they call integral features. Integral features are things like your heating and your lighting. Now for that there is a 50% relief that was announced in March, but let's not forget that actually you're better off using your annual investment allowance, which would give you 100% relief on your integral features, rather than using the super deduction. So moving on to business taxation. Now, a lot of you may be thinking, well, what's the difference between company taxation and business taxation? Business taxation includes sole traders and partnerships as well as companies. So for sole traders and partnerships, they also benefit from the extension to the annual investment allowance. But you'll notice that actually what I haven't got up there is the super deduction. So sole traders and partnerships don't benefit from the super deduction. The other thing that seems to be part of the Chancellor's speech on a very regular basis now is business rates. I seem to be looking back thinking there aren't many times that the Chancellor has stood up and not mentioned something about business rates. And once again, he's decided to do a little bit of tinkering with business rates again. And I've got to admit, while I was stood there listening to him, I got very confused with all the things that he was talking about at the time. So I picked out on just a few items of specifics. So there is going to be a temporary 50% relief for retail, hospitality and leisure. And you'll notice that I can't spell retail. There's going to be a relief for premises adopting solar panels, and there's going to be a 12-month business rate holiday on property improvements. So if you're going to improve your property, you'll find your rates won't go up for a 12-month period. I got the impression from his speech that business rates is going to be something that he's going to continue tinkering with. So I think we will see more change on the business rates front as we go along, and it does seem to be a more and more complex area. Personal taxation. Well, for anyone who was watching the budget, there wasn't an awful lot going on in that speech in relation to personal taxation. So I was thinking, oh, what am I going to say? But then I remembered there was quite a lot of change actually in March already. So at the moment we've got the personal allowance, and it stood at £12,570 for the current year. And what did he say in March? He said he was going to freeze that allowance for the next 5 years. So that amount, £12,570, will still be our personal allowance in 2025-26. The higher rate threshold. So for this current year, the higher rate threshold, so the threshold at which you can earn up to and only pay basic rate tax, is £50,270. What did he announce in March? That that would also be frozen for the next 5 years. He didn't announce any changes in relation to the rates of what I would call standard income tax. So our basic rate, higher rate and additional rate of tax remains at 20%, 40% and 45% respectively. But what did he announce a number of weeks before the budget? He announced the social care levy. So from next April, he's introduced a new social care levy amounting to 1.25%, which is going to apply to all employees, employers and the self-employed. Now the levy for the first year is going to be brought in through the national insurance rates. So from next year, the national insurance rates will increase by 1.25%. Now this does mean that for anyone over state pension age who doesn't pay employees' national insurance, they won't pay that social care levy for the first year. After the first year, so when we get to April 2023, the social care levy is going to be separated out. So it's no longer going to be collected through the national insurance, it will be collected separately. And at that point, anyone who is over state pension age and still working will pay the social care levy. Now, just so that people didn't feel left out if they've got some dividends, at the same time as announcing the social care levy, he announced an increase in the dividend tax rate. So from next April, the dividend tax rates are going to increase by 1.25%. So we will have an 8.75% rate for dividends falling into the basic rate band, a 33.75% rate for dividends falling in the higher rate, and 39.35% for dividends falling in the additional rate. And who thought we only had 3 rates of tax? Moving on to VAT. Well, he didn't mention anything about VAT in the speech either. So our standard rate of VAT remains at 20%. But the one thing he announced back in March was that the temporary reduced rate on food, attractions and accommodation is now being phased out and will go back to the standard rate. So from the 1st of October, the rate increased from 5% to 12.5%. And from the 1st of April next year, the rate on food, attractions and accommodation will go back to the standard rate of 20%. So he also mentioned a number of different changes to duties. Now, I will say, I don't know an awful lot about duties, and there's not many people who actually get involved with things like air passenger duty and alcohol duty, because that tends to be for the big boys. But I wanted to mention it simply because, as part of our discussions while we were in the conference room watching the budget, flying next year to Scotland was obviously a topic of subject conversation, because it should be slightly cheaper, because they are going to reduce air passenger duty on internal flights. Now, I will say our topic of conversation was much more engaging in relation to the alcohol discussion. So it was quite interesting when the Chancellor announced that there are 15 different rates of alcohol duty. Now, to me, that does seem excessive. I work in tax. And so when he said he was going to reduce it to 6 rates, I still thought that was excessive. But not knowing too much about it, I thought it's better than having 15. Now, it was only better for me, I found, because I quite like Prosecco. But for some of the team who preferred gin and tonic, they weren't quite so keen. Now, throughout the budget, the one thing we saw is that not an awful lot seemed to have changed. He didn't make that many announcements. Now, for me, I'd been expecting to hear a fair number of announcements, so at the end of it, I felt rather lost, thinking, oh goodness, what's going on? But when I take a step back and think about it, we normally only have a budget once a year, so to expect there to have been changed within a 6-month period is probably unusual. However, we had got used to having change happen very, very quickly. So over the last 2 years, we were seeing things changing within a 24-hour period, so we'd got used to that fact. It's quite nice perhaps to have a little bit of stability for a short period of time. Now, I say a short period of time because we are going to have another budget in March, and I will once again be interested to hear what he's got to say at that point in time. Now, on that note, I am going to pass over to Tom.
Can anyone hear me? Good. I can hear me. Can anyone hear me at the back? Good. Excellent. Hello to everyone at home. Good morning to everyone who's joining us. It's great to be here. Sorry for the slightly croaky voice. Apologies. So, as Amanda said, there wasn't that much in the budget, but I'll talk through and start with capital gains tax. So, as with lots of other taxes, the rates and the allowances and everything was frozen, and it looks like they will be frozen until 2026. So, there's been some tweaks though to capital gains tax. That tweak concerns the residential property return. So for those of you who don't know, capital gains tax on residential property is treated differently to capital gains tax on anything else. This was a measure that was introduced last April, 18 months or so ago, and it means that if and when you have a capital gains tax liability on residential property, you have to pay it at either 18 or 28%, as you did before, but you have to submit a return and pay the tax within 30 days. So, since following the completion of the sale. Obviously very different to capital gains tax on everything else, which you pay in the January following the end of the tax year whenever you've made that disposal. So that could be, over a year, 18 months in the past, then you have to pay it in the following January. One of the main problems that we found, and I'm sure Amanda and Lexi have with their clients as well, is that most people don't even know that this applies, that this is a rule that applies. And then even if they do, they don't find out until completion, and then you've only got 30 days to submit the return and pay the tax. The return is submitted via something called the UK property account, which is all done online, so there's no paper returns. And in order to do that, you need a government gateway account. That even with a very fair wind, you won't be able to get those things signed up within 30 days, even if you've got all the information. And the information that you need to get those two things is quite considerable. So it needs national insurance number, dates of birth, all those sorts of things. So really, we were finding a lot of people were missing those returns or had sold a property, had no idea, and then months later found out and were in all sorts of difficulty afterwards. So it was quite unpopular. So lots of people were upset about it. The Office of Tax Simplification said that the problems were, it was unreasonable, and it was a lot of people were completely unaware of it. It did do well for the Chancellor though. Last year, £935 million extra was put into the coffers due to the additional return for residential property. So he wasn't too upset about it, but lots of people were putting pressure on him and saying that it was unfair, unreasonable for taxpayers, and it was laborious and too difficult to do within the time period that had been imposed. The fines, not huge, but not very pleasant either. £100 if you're late, and then if you're 6 months late, then you have to pay up to 5% of the gain. So if you've got a considerable gain, which with house prices as they are, that could be a really significant liability for something that's not well publicised and not many people know about. So what did he do yesterday? Well, as of Wednesday, so straight away, he extended that deadline, or doubled it from 30 days to 60 days. So it's still outside of the usual capital gains tax return, as in done with your usual tax return, but it must be 60 days rather than 30 days. So it's been described as taxpayers being able to breathe easy, as they've got 60 days now rather than 30 days. But it's still something that I think needs more publicity, more people need to know about it, because, as I mentioned, just to get signed up takes a lot of time and a lot of information needed. So people still need to be aware of it. I think even if they're starting to think about selling residential property and suspect there'll be a liability, they need to get things done, well in advance, because it's still not long. There was some confusion about properties that involved some residential elements and some non-residential elements. So, say a building that has a shop or a retail unit downstairs and then a flat upstairs. People were confused about whether they needed to deal with the 30-day return for everything or just for the residential or what. So that was clarified as well on Wednesday, that it is just the residential element that only needs to follow the 60-day reporting. Will there be future changes for capital gains tax? Well, the Chancellor himself said that he didn't understand why there was a distinction between capital gains and income taxation. So some commentators were thinking, well, maybe now was the time. Those were disappointed and nonetheless embarrassed because no changes. So he's kept it fixed, just like Amanda was saying, for lots of taxes until 2026. So it looks like we're stuck with the allowances and the rates that we've got now until 2026. As Amanda was saying, that means in real terms, with inflation, what, 4%, I saw on the papers this morning, it might hit 5% before too long. Obviously in real terms, then taxes are going up every single day, because although we might not notice it as much now, £4 on a shopping bill of £100, by 2026, that's going to be a very significant increase. So that's just a quick reminder of the rates. So as I've said, residential property, it's 18 and 28%. For all other gains, 20 and 28. And the annual allowances are fixed, 12,300 and 6,150 if you're a trustee. So inheritance tax, a quick run through here. Again, it's more of what's not happened than what has happened. The rates, again, are frozen until 2026. So the rates and the allowances have stayed the same. When we did a talk back in the budget in March, I did finish by saying that maybe in the sort of tax day, which is where they announce their future plans, there might be something exciting in there about inheritance tax. There wasn't. So it looks like inheritance tax is being kicked into the long grass until 2026 at least. The reason I'm mentioning it is because, again, with inflation likely to be 4% before too long, and with house prices as they are. So the statistics that I could find yesterday show that in August, the annual rate of increase for house prices was 10.6%. So obviously if your allowances are fixed, if your allowances aren't going anywhere, then it means it's going to be very significant increases in real terms. So just a quick look at the allowances. The nil rate band allowance, so that's for everything, is £325,000 per person. And then there's the residential nil rate band, which is £175,000. So for a married couple, combining those allowances, the total allowance is obviously going to be £1 million. But that nil rate band allowance has been the same when I had few less grey hairs and was a trainee. So back in 2008, it hasn't gone up. So and it won't go up until midway through this decade. So what's the expected revenue? I took these figures back in March, and I imagine those figures are probably now out of date considering the house prices rises that we've seen this year. It's going to be nearly, best part of £983 million in increased revenue just by fixing the allowances. And who knows whether that's going to be accurate or not, because if house prices keep going up as they are, then that figure could be much higher. Right, not much else to talk about on capital taxes, so I'll just run through a case that we've had relatively recently, which concerns business property relief. So for those of you who don't know, business property relief is a complete exemption about inheritance tax, so it applies when a person dies or when assets are being put into trust. It's either 100% or 50%, depending upon the assets. And it's used for assets that are involved in a business or the business itself. Those assets must be owned by the person who's died or who's transferring them at least 2 years before. So quite a valuable exemption. As we've talked about, inheritance tax is a big issue for people. So business property relief is very useful. The case itself considers whether or not an asset or a business is wholly or mainly holding investments or not. So the way we would talk about it is whether an asset or business is an investment asset or a non-investment asset. So holiday lets are right on that sort of boundary. Some cases go one way, some cases go the other way. They really can fall depending upon the facts. So it means that for people like me who are interested in this sort of thing, it's quite exciting to see new cases because you can start to draw exactly where those lines are, and it's the case law that sort of dictates the finer detail. Sometimes it's a positive, sometimes it's a negative. So this case involved a Scottish set of holiday lets run by Mr. Cox. It was in a converted building that was a single house, called, it sounds quite grand, or at least was made to sound quite grand. He referred to it as the castle. It was split into 5 flats. He lived in one. He owned 3 more. The fifth one was owned by someone different, not involved. He let them out individually, and that was his full-time job. He would look after them, clean them, let them, advertise them, all those sorts of things. He eventually sort of wound down his activities. But when he died, his daughter took over and moved into the flat. So the evidence that was put before the revenue, before the tribunal, actually was done by the person who was actually managing it. So initially, the revenue refused the claim for business property relief. They viewed it as just a letting business, that a person's letting those flats on holiday lets, but not actually involved in what we would call a trading business. They considered it as an investment. The executors, which were the deceased children, made an awful big deal about all the additional activities, what they considered their father going above and beyond just letting a flat and getting the income from it. So these are the things that they listed, which I as I'm sad, quite found a little bit amusing. So they allowed, being in Scotland, they were near lots of golf courses, so allowed you to use a golf course, go to the beach, so buckets and spades and all those other things you need, books, They made a big deal of the fact that once or twice they allowed people to go out to the pub and let the baby sit. Revenue weren't quite so convinced about that. And one of the guests got drunk and fell over, so they drove them to the hospital. Again, the revenue, well, the tribunal found that actually that was more, he was more interested in trying to avoid getting sued because the outside lights didn't work than providing additional services. The guests described him as an outpost of the tourist board. So this can be key in some cases where people don't just greet them, they give them the rundown of where to go, and they book days out and do all sorts of other things. And that was what they claimed, the executives claimed in this case. But what happened? Well, the appeal was dismissed. So in and of itself, this case doesn't tell us much, but what it does do, because when the tribunal referred to other cases, it allows us to get a clear idea of what would be considered trading. So what would be, in the words of the tribunal, exceptional additional services, which would mean we're eligible for business property relief. So this is what they drew. So they gave us a really good example of what would be considered exceptional. So if you've got holiday let, you're advising someone with a holiday let, you need to have things like a swimming pool, a games room, prize-winning gardens, I don't know what prizes in particular, but prize-winning, fresh seafood at cost, groceries for delivery. So that would be considered exceptional. What poor Mr. Cox was doing was not considered exceptional, even though he'd driven people to the hospital when they got a bonk on their head, or he looked after their children. The revenue were the tribunal were very careful not to criticise the children, but what they said was the implications from what was described as additional services were overstated. They said they didn't overstate what they did, but the implications they got were overstated. So a useful case when you think about holiday lets. As I say, it's an interesting area for people who sound like me, who find this thing exciting, but there we go. We all know now, next time we go for a couple of weeks down in Cornwall, we know whether something's exceptional or not. I'm looking forward to the prize-winning gardens myself, but there we go. So that's everything from me. I guess we'll hand back to Lexi to field some questions.
Tom, thank you very much. Amanda, thank you very much. Do you want to come up and join us too? We're just waiting for our online questions to load up. So are there any questions from the room for Amanda and Tom? Gentleman back there.
I'd like to ask Amanda a question, please. You talked earlier that you'd like to know where the income to the government's coming from. And the income levels are already at historically high levels. The Chancellor said that his ideal would be to reduce taxation, and there will be an election in 2 or 3 years' time, and no doubt that will be on his mind. So where do you think his range for manoeuvre is going to be?
Good question. This is what we were debating actually afterwards, is how is this all going to happen? One of the slides that Tom just put up actually does help to explain some of those things. With the inheritance tax that Tom was mentioning there, the increase in inheritance tax take, I think you mentioned there, 983 million. The Chancellor is hoping that the freezing of allowances will help cover all of this spending. And I think that's what he's sort of banking his hopes on, that the economy will continue to grow, unemployment will continue to fall, and we will see better than predicted performance over the next 5 years, thanks to these freezing of allowances. I think that's what he's sort of hanging his hat on at the moment. After reading everything that he announced back in March and this time, I think that's what he is hoping for. He did say at the end of his speech that yes, he does want to actually reduce tax. I think he's going to have to be very careful with doing that, but he does have to think of an election at the same time. If we're going to see anything happening, it will be just before that election. Now, while we were sat there, we were having a discussion, and someone actually in my team said, this sounds like an election budget, because he didn't do anything. And he was promising, or aiming to promise, to reduce taxes. So it did sound like an election budget. I do think he is hanging his hat at the moment on the economy recovering after COVID much faster than we possibly expected it was going to before, and that these freezing of allowances raises an awful lot more money than we thought it was going to. It's amazing when you think 5 years' time that allowances are going to be exactly the same. We're going to notice that. We're going to be looking at the personal allowance in 5 years and saying that's now a really low level. So I think he has hung his hat on that, and we're going to have to see. But I think it's going to be interesting over the next few years. If he is going to make any tax changes, I think we might be in the next March budget that he does anything, because that gives him enough time to recover, ready for the election. But we'll just have to wait and see. He's been an interesting character.
Thanks, Amanda. Any further questions?
Just very quickly, again, Amanda, do you think the Chancellor's actually stoking inflation? Because it's obviously a lot higher, we've all noticed it, empty shelves and, you know, petrol and all the rest of it. Everything's going up, it seems to me, and shortage of supply.
Interesting take. Stoking, I don't know if I'd go as far as to say stoking. What I found interesting in the speech is that he said all the positives about the government will act, and that he'd written to the Bank of England to say that, reaffirm we want stable and low inflation, but he didn't give anything further. I would have thought that he would have maybe gone a little bit further to say what he might have been going to do to help inflation. Stoking, I don't think I'd go as far as to say stoking, but I don't think he's doing quite as much as maybe he will over the next year if we see inflation go any further. He's definitely not dampening it down at the moment.
Thanks, Amanda. Any further questions?
Yeah, so based on his comments to the Bank of England about giving them the authority to control inflation, do we see then that interest rates are likely to rise sooner rather than was originally anticipated?
I don't know.
We might find out next week.
We might find out next week. Yeah. I think it's something that was one thing I looked at and thought we need to keep an eye on that. As I mentioned earlier, inflation is double what they'd originally aimed for with this government. He hasn't done anything at the moment to really address inflation. He's mentioned it, and he said he's done a couple of areas. It's something to keep an eye on, and I don't know the answer to that one.
I might be able to help a little bit, only in so much as I was at a Bank of England breakfast recently with the South West agent, and she did say that from the Bank of England's perspective, they are keeping a very watchful eye on it. Certainly, I think there are some differences in terms of the forecast between what the Bank of England are expecting in terms of inflation and elsewhere. Their expectation was that they were basically saying we should expect to see an increase, but if we did, that it would be pretty marginal. It would be not a significant increase, but there was probably likely to be one on the horizon. So that was the feedback from the breakfast. Tom, I don't know if you wanted to add anything.
Only that I saw in the response to the budget that some mortgage companies have already put their interest rates up, and so it sort of adds into the discussion that everyone's having about inflation, because if mortgages are more expensive or the rates are going up, then it seems inevitable that interest rates as a whole would go up, but we just don't know. But it looks that way, certainly.
Thanks, Tom. Thanks, Amanda. Any further questions from the room? Perfect, okay. Well, I don't think we've had any online submissions, so I think that just really draws everything to a close this morning. So I'd like to thank Amanda and Tom for your presentations. They're really insightful. Thank you very much. And thank you all for joining us this morning. And do stay on and have a coffee and catch up afterwards. Thanks, everyone.